Welcome to the Balance Blueprints podcast, where we discuss the optimal techniques for finances and health, and then break it down to create an individualized and balanced plan. I'm your host, Justin Gaines, here with my co-host, John Prober. In this episode, I break down what a meeting with a financial advisor about your financial future should look like. I hope you enjoy it. Thanks for listening. The first meeting is generally the same for every client, and that's because the client's going to do most of the talking, and they're going to give me the information to understand their picture so that I can be their guide and walk them down the pathway and help them see what's the best route for them. And I just think it'll give a good overview of how we operate the business and the perspective we have, like we've talked about before. Hopefully this podcast is seen by tons and tons of people, and I'm not able to work with everybody, and there's certain states that I can work with people and there's certain states that I can't. Just to list those off quick, currently, as of the recording of this podcast, I'm licensed to operate in New York, Vermont, Massachusetts, and New Jersey. So 4 states gives me a large area that I can work with people. We can jump on Skype calls, Zoom calls, whatever's best for the person. But outside of those states, this overview I'm hoping will create the ideal situation for somebody that when they go to meet with a financial advisor or insurance agent, they know what to expect and what they should be having in that meeting. Mm-hmm. And when we get to the end of the meeting, I guess we'll highlight those areas. But I think as you see this process, you'll see it unfold. And it's a process that we're constantly adjusting to make sure that we're doing the right thing. But our main focus is getting to know the client and educating the client, whether we're going to make a sale or not.
Yeah. This goes for, I know you're saying we as your company, but it's funny because it goes for both of us. You know, the biggest things we try and do are listening to our clients, get their story, and it's even in the name. Actually, maybe it's not, but it's in our intro. You know, these are meant to be, everyone has an individualized plan. So,
right.
You know,
we're trying to build a blueprint for success. So that a balanced blueprint for success. And that's kind of the focus, is that it needs to be a plan that's not perfect on paper. It needs to be a plan that's perfect for you.
Yeah.
Because you need to maintain it and stick with it long term in order for it to be successful. It might not maximize everything and it might not be the absolute best scenario, but it's going to be the best scenario for you. Because if the best scenario on paper you're not able to commit to and you stop midway, well, it doesn't matter that it would have done amazing, because it didn't do
amazing.
It didn't fit for you. It wasn't a good fit. And so everything has to be individualized for the client in order for it to work properly. And I even point out, like, there's obviously certain licenses that I have, and in my meetings, I will point out, listen, I'm making this recommendation and I am biased towards this area because, you know, there's a commission there or there's an opportunity here, but I'll explain what their other alternative options are. And almost every meeting that I have, I'm sending somebody to somebody else or setting them up with something else that doesn't give me a commission, doesn't give me a ounce of value, but it gives the client value. And so the value that I'm getting is that building of rapport, which honestly segues us right into the first talking point of the meeting. So I've been introduced to somebody. Generally, those introductions will look like either the vast majority of my introductions are done through text message, believe it or not. I typically have them, the client or the person that I know, put myself and my business phone number in a group text with whoever they're introducing me to. Give a quick summary about how I've helped them, the value I've given them, and then introduce the other person as well. What that does on my end is the text message is received in our CRM system, but I actually don't see the person that you're referring to me. I don't see their number until that person responds. When that person responds, their number pops up. And so it creates a comfortability element for the client, because they know that, well, I'm not just giving you a phone number of somebody and now you're going to harass them until they meet with you. I work with enough people, I offer enough value where I get enough introductions where if somebody's not interested in working with me, I'm not going to waste my time harassing them to get something. It's just not who I am. I don't do high pressure sales. I'd rather work with the individuals that want to improve their financial position than try and chase somebody who's not interested in that. Because the other thing that I find too is there's been times I get these text introductions, and then a year and a half later, I get the text message back or I get a phone call. Hey, you probably don't remember me, but so-and-so introduced me to you like a year and a half ago. It wasn't a good time for me. Now I'm really interested and you didn't harass me. Can we meet?
Yeah.
Are you still doing this?
What I found is people always have to come on their own terms, for health or financial stuff. You can't pressure them. And we've always had that. I think of like the gym ones or the lower level salesmen. We've all had people constantly bug us and annoy us. And you never want to do business with them.
Well, and even in our relationship, there's certain pieces of your financial journey that we both know that need to happen, but the time hasn't been right. And so like, maybe once a year I bring it up to you of, hey, we need to have this conversation. Yeah. And we leave it at that. Like I bring it up to you. I tell you we need to have it. I've done my part to get it off my conscience so that if something does happen and you're not protected from that, I've at least advised you and said, listen, there's an area here that is a vulnerability of yours. We need to address it. And at some point you'll come to terms with that. You'll reach out to me and we'll get it taken care of. But it's one of those things, like you're saying, you have to come on your own terms. And that's because I'm going to guide you on this financial journey. And I can create the pathway for you and I can show you what that pathway looks like. But at the end of the day, you have to be the one to walk down it. And so you have to want to walk down it. I'm not going to drag you down the path, and I can't drag you down the path. So we need you to come to terms with that. So in the very beginning of the meeting, the first thing that I talk about, and the reason we do this is because it's typically weighing on the person's mind, is how do I get paid? And how much is this going to cost you? Because a lot of times people even ask me that before they'll meet with me, because they're so used to somebody charging an hourly rate or there's a set fee. And so they're like, I don't want to waste your time if I'm not going to pay this fee, or I don't want to waste my time and then find out that I'm getting a bill for $500, $1,000, $1,500 for this financial planning meeting. And the reality is even the individuals that do set hourly fees, typically that first meeting is going to be, it's technically an improper use of the term, but pro bono. It's not going to be charged. It's going to be an introductory meeting, 30 minutes, an hour, get to know the person. My introductory meetings typically are an hour to an hour and a half where we're getting to know the person. There's not charged. The way I get paid is by two ways. If we work with a company and I place assets with them, then they're going to pay me as a result of me placing business with them. So that's going to not change the amount of money coming out of your pocket. It's going to be just part of your strategy. We buy that product or invest that money there, and they're going to kick me back a portion of that in order to be compensated. And then the other way that I get paid is through introductions. So I ask that if I offer you value in this meeting, that you will in turn introduce me to somebody you know, and somebody's typically 3 to 5 people. Introduce me to 3 to 5 people that you know that if they met with me, they would also get value from this. Vast majority of my meetings, I'm giving out more value than I'm getting in return. And that's why I ask for those introductions, is because if I can talk to enough people, it essentially becomes a commodity business. If I can help enough people and even just make a small amount on each person, instead of trying to go after one person and sell them snake oil and make stupid money, but I'm only helping one person a week or one person a day, that's just not the business I'm in. I'd rather work with you, put you on a journey long term, make a small amount of money, but impact a much larger percentage of people. Because a lot of the financial planning that I do, and generally speaking, just a lot of the financial planning that most people need, is very simple, but you don't know what you don't know. So until you have somebody point it out to you and put the plan together, then you start to see like, oh, okay, this is very, very simple, easy, and boring. Then you can do it. And honestly, if the plan you're getting isn't simple, easy, and boring, it's probably not a good plan.
Yeah.
And easy is relative, right? So easy, you're going to have growing pains because you're putting money in different areas and you're starting to spend money or invest. You're not spending it, you're investing money, but it's coming out of your budget. And so you're not used to that. But it's easy in the sense that, okay, I know that if I get a raise at work, this percentage of money is going to go here and this percentage is going to go there, whether it's a percent or a dollar amount, but we know how to distribute money once it comes into our bank accounts. So I always just ask, is that reasonable? Typically the client will say, yes, that's reasonable. And then we know we are getting paid out in the open. I know how I'm being paid. They know how they're going to pay me. As long as everybody's happy with that and they're comfortable with introducing me to people, then we're good to go. And it's also contingent upon, you're not introducing me to anybody if you didn't feel there was value in the meeting.
Yeah.
If you don't feel that I gave you value, don't introduce me to anybody.
No pressure there.
Right. If you should be walking away feeling good about our next steps. If you don't feel good about our next steps and you don't feel like you learned something in this meeting, you're not introducing me to anybody. Because if I haven't helped you, how can you tell somebody else that I'm going to help them?
Right. Right. So there's tons of incentive there for obviously you to provide the value. And also, everyone's different. There's tons of people that are going to need help, even if you just don't jive with someone. I think taking that pressure off of it, and there's a couple ways you're trying to do that with being upfront about cost first, because that's always a concern. And that text system, I didn't know that. It's pretty cool. I think that's definitely something that could be advertised more. It's nice that you can't see people's numbers, because it's a pain when you get harassed by someone just for wanting to acquire information. But
right.
You taking that pressure off those two things, I think, is nice. Of like, it's not really a sale, even though it is, but you're not a predator trying to make a sale as much as like just a person who has a job that's about financials, that if you want help, I'm here.
Right. Well, and you've even seen firsthand where I've taken on clients that have gotten financial plans from other people.
Yeah.
And then I explain, this is why that person made that financial plan. This is the strengths to that plan. These are the weaknesses. And a lot of times those plans that I'm able to point out the weaknesses in 5 minutes to, it's because there's typically some sort of really hefty payment from the company that they're working with. And I can show you what that payment's going to be. And you've seen it with clients that I've worked with that are close friends of ours, where I outline, okay, this is what the old advisor was going to have you pay in, and this is what this is what the advisor was going to be paid. Taking the same amount of money, distributing it differently in different accounts and different systems, this is what I propose, and this is how much I'm going to be paid.
Right.
Do you see where ours is going to grow and get into distribution, a higher distribution than this one's going to be? But can you see why the advisor made that recommendation?
So that's a great technique to show, like, hey, I'm going to save you a little more money than they're saving you, and I'm going to do this. Like, you can stay with them if you want, but I'm just showing you this. Like, you can pay the least amount with me, and it's not always an undercut game, but you're just giving them examples of how you can do better at a more reasonable price. And it's like more people are probably going to want to pick that one than giving their money to a big company.
Well, and a lot of times it's not a matter of them even paying less. It's typically them distributing the same amount of money in their budget, as long as the budget was taken into account properly. So as long as a budget was determined for the client and they could afford the plan with the other advisor, it's not a matter of them paying less, because we want to put as much into our accumulation accounts as we possibly can. And I'll get into these terms that I'm using next. But we want to put in as much as we can, because the more we put in now, the more it's going to be able to compound and the more it's going to grow, so that we have the opportunity for distribution and legacy. Now, if we don't put in anything, the opportunity for distribution and legacy declines. And a lot of times legacy gets completely booted and we don't have the fourth phase of financial planning. But the next portion of our meeting, which since I'm using these terms, I want to jump to that.
Yeah, let's go over those.
We talk about compensation. The next thing we do is we educate on the 4 phases of retirement. Now, most financial advisors only talk about one of these phases. And as I talk about them, you're probably going to know exactly which one it is if you've worked with a financial advisor. And I would also say that most financial advisors are aware of only 2 of these phases and ignore phases 1 and phase 4. So phase 1 is contributions. Phase 2 is accumulation. Phase 3 is distribution. Phase 4 is legacy. So phase 1 and phase 2, you're typically in at the same time. You have to go into phase 1 to start your retirement planning, which is you starting to contribute to retirement vehicles. We can go over all of those vehicles that typically would fall into meeting number 2. We'll touch on different vehicles in this meeting, but generally speaking, going deep on these would be meeting number 2. So we'll break it up into additional podcasts as well.
Yeah.
So you're gonna start contributing to investment vehicles, and then you're going to start accumulating within those vehicles. But contributions isn't a one and done phase. You have to continually contribute in order to maximize your accumulation. You want to accumulate and you want to build those. This is where most financial advisors sit, is in the accumulation phase. All they're talking about is how quickly can I grow your money? They show you, if you contribute this amount, this is what your retirement accounts will grow to.
It's flashy. Sounds good.
Sounds good. It looks great, right?
Yeah.
Some advisors, the good advisors, not the great ones, but the good ones, will talk about what it looks like in phase 3, which is distribution. The good advisors will tell you, okay, you need to accumulate this amount of money, and if you do this, it'll distribute in retirement as this. You're going to look at Social Security distributions. You're going to look at distributions of your accumulation of your wealth. Now, things that they should be taking into account when they're showing you this distribution is, what are the taxes going to be on the distribution? How much are you going to lose to Uncle Sam when you distribute these? Because if you're not in tax advantaged accounts, your accumulation gets greatly depleted by taxes as a result of trying to distribute. So we want to look at tax advantage accounts. We want to look at Roth IRAs. We want to look at 7702 plans. We want to talk about 529 plans, which kind of part of legacy planning, but 529 plans if you're saving for a kid for college. We want to look at all these different tax advantage vehicles.
So those are accounts that they just have tax benefits or less taxes when you withdraw?
Correct. To keep it simple, and what we talk about here is, generally speaking, those accounts have less or no taxes in distribution.
Okay.
And so we want to do our financial planning based on distribution, because the only reason you're contributing and accumulating money is so that you can distribute as much money in retirement. Because effectively, you're retirement planning. You're not accumulation planning. You're not trying to just have a ton of money. You're trying to have a ton of money so that you can distribute it and have a certain level of income in retirement. And then after you get through retirement, what do you want to leave to your kids? What do you want to leave to your grandkids? Maybe you have a charity that you want to leave money to. If you're involved in a religious organization, maybe you want to give money to your religious organization when you pass away. That's legacy planning. The great advisors will talk about all 4 phases: contribution, accumulation, distribution, legacy planning. The good advisors will talk about 1 through 3. They'll focus on 3 or 1. Yeah, 1 through 3. They'll focus on 2 and 3. The financial vampires, the ones selling snake oil, they're going to focus on one of them. Some of them will focus on accumulation, and that's because they don't realize that they need to take into account tax implications and all of these vehicles in order to figure out distribution. Or they only focus on legacy planning, and they're just trying to sell you a ton of life insurance, and they're not worried about accumulation, distribution. They're just, this is how you're selling legacy, and this is how you have the most life insurance, and you can pass it on, and you can be like the Vanderbilts and the Rockefellers and build these huge trusts and do universal banking and all these cool things. Those are cool things, and they are legitimate strategies, but are they legitimate strategies for you? If you're coming to me and you haven't even talked about phases 1 and 2, we can touch on those strategies and we can talk about those strategies, but we're not going to actually develop any of those strategies for a good 3 years of working together when we know you're actually going and doing a good job of contributing to these accounts so that we can do distribution. But I develop the plans backwards. I'm not developing a plan based on how much can we accumulate. I want to look at how much do you need for distributions. Generally speaking, as a good rule of thumb, and you can reach out to me if you want to get the nitty-gritties on these numbers, but generally speaking, $1 million of investable assets and invested assets will generate you, through the proper planning, $2,000 of retirement income in perpetuity. So this gives us a very conservative target to hit. That it's aggressive, but it's conservative as far as making sure we have enough money in retirement. Mm-hmm. So if you say that you want to have $100,000 of income in retirement for you or you and your spouse, that means that monthly you need, what's that going to be? It's going to be.
Wait, are we talking 100,000 yearly, 100,000 total?
100,000 annual, 100,000 annual income, and that's adjusted for inflation.
Yep.
So We can use the $2,000 today, adjusted for inflation. We need the $1 million. $1 million today generates you $2,000 of income in perpetuity. So for the rest of time, adjusted for inflation.
Yeah.
So if you have $1 million in your retirement account, that's going to generate you $24,000 a year effectively. Mm-hmm. So if you want to have $100,000 in retirement income, you need to have $4 million in retirement assets. Yeah. Now, if you miss this target, if you want $100,000 and you miss it and you hit only $3 million, it just means because we're looking at perpetuity, we don't have to take into account if we hit that target, your life expectancy. Mm-hmm. Because by doing it in perpetuity, we've hit both our distribution planning and our legacy planning. Because when you pass away, you will have not completely depleted the asset. You'll have a significant asset to pass on to your kids. Yeah. And so that's what we want to have as our target, is have something we can pass on to our kids, to our charities, to our churches, whatever the case may be.
Yeah. And something important that you hinted on, and that happens a lot in the health world too, is your life, your lifestyle, and things that come up change. So, you already kind of got into it before I could even mention it or ask, but distribution is very dependent on the type you want, the type of life you want to live as well. And because it sounds like great, I know you're saying 100,000, if that's for two people, it makes sense. But I'm thinking, man, 100,000, it's like for a lot of people, that'd be maybe way more than they even make now. So it's very specialized, and I'm sure it will change even between the year of, your age of 50 to 60, it could change of how much you want or need. And I think that's a great reason why in the health world and the financial world, you keep checking in with yourself. And if you may be good for 20 years, you may not have to work with a financial advisor or a health expert, but then something changes. It's never a problem to go back and re-go over things, change the plan a little with, the help of someone.
Right. And part of the reason why my meetings take an hour to an hour and a half is because we're developing a system where we can meet every year. And we can meet, honestly, if we're going to just cut straight to business, we can meet for 15 minutes. And we can evaluate, okay, where's everything? What accounts have moved? What's changed? Are we still on track? Do we need to adjust? Mm-hmm. Are your targets the same? Is your lifestyle expectations the same? And then we can adjust those in a 15-minute, 20-minute time frame. Yeah. And so, like you said, that's why we build it in reverse. Is if you only want, say you want $50,000 of income in retirement, well, now you only need $2 million in assets. And so it's one of those things that if we can adjust and plan appropriately, we can get into a position where we know how much we need to accumulate. And if we know how much we need to accumulate by retirement age, and we pick a retirement age, we now know how much we need to contribute in order to hit that target. Yeah. And if we touch it each year, we can see if we need to adjust our contributions or not.
Yeah, it's important to, because this is important for me, and I think other people as well, whether it's health or financials, like we want to feel empowered. So you give us the information, but you're always there as a tool. Like you are one of the tools, including all the tools you give us. So it's like we are able to go the whole year without you, but then once a year, use you as a tool to check in. But that's the name, that's the name of the business.
Well, and that's part of the reason why we set up the text in the office is you can send a text and say, I'm thinking about buying a car. Can we meet to talk about how that's going to impact my finances, what I should be looking at as far as financing options? How should I go about this? How should I go about negotiating with the car dealership? What should I be looking to get out of this in order to keep on pace? And then if we can text about it, we'll text about it. Otherwise, I can send you a link. You can book a time on my calendar and we can talk for 20 minutes, 30 minutes and really flush this out and make sure we have a good plan. Cool. But like you said, things are going to change. Things are going to adjust. But if we just try to accumulate as much as possible, I found that clients don't stick to that path because, I'm going to have, if I contribute at this level, I'm going to have $2 million in retirement. I'll be okay. But if you want $100,000 in distributions, you won't be okay. And so if you think you're going to be okay, you're not going to stick with the plan. You want to know exactly how much you need to do in order to get there. And if we contribute more, maybe we can get into retirement quicker. If we contribute less, maybe we just push out our retirement age. These are all things that we can play out and determine when we put this plan together.
All right,
so once we have the 4 phases down, then I have a document that we put everything into. It's a simple Excel document. And I start to get you to think about yourself like you think about a business. So even if you're not a business owner, we're going to look at your financial image in a non-emotion driven way as a business. So we're going to get to the facts. We're going to create a balance sheet for you, and we're going to create an income statement, essentially, which is going to be your budget. What that does is, in order to evaluate a business, you need to have at least 2 financial statements, ideally 3, in order to get a full picture of the business. Now, with an individual, because the business operations are much simpler, effectively your income statement and your statement of cash flows end up being generally the same. There's not much difference there, especially because most people are doing a budget on what would be cash basis accounting, which means your cash flow and your income statement are almost identical, if not identical. So by doing these 2 statements, we're effectively creating 2 to 3 statements for the individual. With the balance sheet, we look at all of your assets and we look at all of your liabilities. But most people don't understand or know what their biggest asset is. If I asked you, what would you say your biggest asset is?
What I own right now.
And it's actually not. What your largest asset isn't anything that you own. Your largest asset is your ability to generate income. So if you're going to work from age, say you work from age 25, you go to college and you take a gap year, you get a master's or whatever. You're going to work from age 25 and you're going to retire at 65. That means you're going to have 40 working years. So if you say you make $50,000, and we'll just, for easy numbers, we'll say you make $50,000 every single year, no income, no adjustment for inflation, no raises, no nothing. $50,000 times 40 years gets you to $2 million, which means your income earning potential is $2 million. Now, realistically, your income earning potential is much larger than that because we have, raises, inflation, all of those things that's going to bump your income earning potential up. Most individuals do not have any assets that are $2 million, especially if they are making $50,000 and this is the first time meeting with a financial advisor. They ignore the fact that they have this income earning potential. And so that's where we talk about, needing life insurance, needing some of these things. It's to protect that income earning potential against and for really your dependents, against a catastrophic loss, but for your dependents. And that's just talking about the death benefit of life insurance, not the living benefits. But we create the balance sheet. We put in your income earning potential as an asset. Now, we don't calculate the income earning potential as part of your net worth, but I put it on your balance sheet so that you're able to see that. And then we also calculate your net worth. The reason we calculate your net worth is as you pay down debts, you're going to be able to see your net worth increase. And so every year when we meet and we update your debt balances, if you have debts, which most people do, so if you have debts, and as we decrease those debt balances because you've made on-time payments, you're going to see your net worth increase. You're also going to see your net worth increase as a result of contributions to these other investment and saving vehicles. And so it allows you to get that energy and that excitement to see, oh, wow, even though I'm only putting right now, because it's what my budget allows, because I'm debt loaded too high, $100 into a Roth IRA, I'm still increasing my net worth because it's going up $1,200 plus whatever gains I had on my Roth. But it also went up by how much I paid down my debts. And now you start to get excited. You start to get that energy and see how your net worth is adjusting. And it's on a J curve. So, or it's on an exponential growth curve, not a J curve. So you're going to see incrementally as you go, it's going to increase much faster the larger your accumulation accounts get.
Yeah. This is, again, great examples of crossovers. I mean, it's like the example of paying down debts and contributing to retirement is the same as getting rid of unhealthy habits and including healthy health habits, so it's going to help you grow so much faster. And I mean, that's a great test of like, what's your biggest asset? I mean, because my first initial thought was, well, my health, But then I'm like, well, that's not something that's like not a physical asset, because that's the mindset we're in for what an asset is. But it plays into, again, the exact kind of thing you're talking about, and why our fields are related is like, well, your health also determines, like what you said, is your working asset. If you're not in good health, that asset for working goes downhill.
Well, and one of the other protection, so it's not necessarily an investment and savings vehicle, but one of the other protection things we do is disability insurance and short-term, long-term care insurance. And that's because if you're in poor health, or you get into poor health, or you have an accident, get in an accident, your health and your working income potential, that largest asset that you have, are directly related. The healthier you are, the quicker you're going to rebound from a car accident, the quicker you're going to rebound from an injury that takes you out of work. And so there's definitely crossover here, and it definitely plays a role where you need to have good health in order to maximize that income potential.
Thanks for listening to our podcast.
We hope this helps you on your balance freedom journey.
Please share your thoughts in the comments section below.
Until next time, stay balanced.